Hey everyone, me Kevin here. Don't mind the, well, hoodie. Instead, let's talk about Janet Yellen because she just mentioned something that is pretty impactful for her opinions of a future market crash. Remember, we have massive fears in the economy of inflation potentially coming and creating a massive market crash. In fact, over this weekend, I posted a video called The Coming Great Depression or Roaring 20s, which is it going to be? And it's all about inflation and the two sides to this argument, which if you haven't watched that yet, it's a must-see. But let's listen to what Janet Yellen talks about when it comes to inflation specifically. We want to focus on her inflation argument and see what her opinions are because they're a little unique from what we've heard before, at least from Janet Yellen. So let's go ahead and jump on in and listen on up. Just remember that if you want to get up to $250 with BlockFi, you can do so by signing up for BlockFi with the link down below. Go to metkevin.com/BF, deposit money, and you get up to $250 totally for free. Now, I'm not going to play the whole interview because she spends like 3 minutes summarizing the stimulus package. We're not going to listen to that. We already know what's in the stimulus package. Let's focus on the economic-related issues and inflation. Here we go.
So I believe there's enough support in this package to relieve suffering and to get the economy quickly back on track. I'm hopeful that if we defeat the pandemic, that we can have the economy back near full employment next year. And I think this is
Okay, full employment next year. Very important statement. Why is it so important? Because what is the dual mandate of the Federal Reserve, and what was Janet Yellen the chairwoman of? The Federal Reserve. The dual mandate of the Federal Reserve, which she was the chairwoman of, is price stability and maximum employment. Now, she said full employment. This is actually a distinction. Full employment generally means we're back to under 4% unemployment. Maximum unemployment means that all races and sexes are under 4%, approximately. There's no hard and true or a steadfast rule that says this is exactly what it is. But generally, we expect all of these levels under 4% to be consistent with full and maximum employment. She thinks we're going to get to full employment. Let's listen to that again, because it's very important in terms of when.
Economy back near full employment next year.
That's 2022. She thinks we're going to be back at full employment. The Federal Reserve so far is widely expected to raise rates in 2023, potentially in 2024. If we get to full employment in 2022, we could potentially see that 18-month warning shot that I recommend you keep an eye out on, which is the Fed starting to taper bonds. If the Fed says we're going to stop buying as many bonds, bond yields go up because you have less buyers in the market. This, to me, means we could still have a pretty glorious 2021 without concerns that the Fed's going to act sooner, that the Fed's going to taper sooner. Every time we hear them speak, we pretty much hear Jerome Powell loud and clear say, we're not doing anything in 21, stop it. It's all reiterating. Janet Yellen, she's coming from the Fed. So we've kind of got two J-Pows here. One at the Treasury now, and one at the Fed. Let's keep listening.
I think this is the package we need to do that.
How about inflation, though? Your predecessor, Larry Summers, has warned of the dangers. Economist Mark Zandi says investors are underestimating the dangers. If we get back to full employment, could we see inflation surge? How big a problem is that?
Yeah. Now, keep in mind, where this question comes from is very important as well. This question obviously comes from the fact that you could still get 38% off today with that expiring coupon code below for bundling up on any of my courses or just individually getting courses like the Stocks and Psychology of Money group, where I help you get through the crazy down periods and not be a paper-handed weenie. The time to sell, remember, is when the market's going up, not down. Check out the tweet I sent and look at the dates of my tweet that I just retweeted from, well, you'll see it. Go to @RealMeetKevin on Twitter. But anyway, why does this come up? If we're going to full employment, why is there potentially this relation to having inflation? This is because of something known as the Phillips curve. Now, I'm not going to go into an economics lecture here about what the Phillips curve is in some complicated way. We're going to keep this very simple. Basically, the Phillips curve says when unemployment goes down, which means more people are working, there is less supply of workers, which means the price of workers goes up, which means potentially we see inflation, because if the price of workers go up, the price of everything could go up. The price of input costs goes up because the price of workers goes up, which means the price of the end good goes up potentially, and we see inflation. Unfortunately, for literally the last 13 years, we have not seen this be true. This has been true in the past, but not in the last 13 years. We've literally seen the unemployment rate plummet from probably its peak somewhere around 2010 off the top of my head, somewhere around the peak of unemployment, I believe. But anyway, since approximately then, we've had this straight line down of unemployment, and inflation has also been going down with it. It's literally the opposite of what you would expect. So this question that George here is asking is a very old school question. Well, wait a minute. If you think we're going back to full employment, that means you think inflation is coming. That's what he's asking. Let's listen to the response. Because remember, big inflation is totally what crashed the market, what could crash the market again.
Well, policymaking is about identifying and addressing risks. And the most significant risk we face is a workforce that's scarred by a long period of unemployment. People being out of work, not able to find jobs, can have a permanent effect on their well-being. I think that's the most significant risk. Is there a risk of inflation? I think there's a small risk, and I think it's manageable. Prices fell a lot last spring when the pandemic surged. I expect some of those prices to move up again as the economy recovers this spring and summer. But that's a temporary movement in prices. To get a sustained high inflation like we had in the 1970s, I absolutely don't expect that. We've had very well-anchored inflation expectations and a Federal Reserve that's learned about how to manage inflation. So I don't think it's a significant risk, and if it materializes, we'll certainly monitor for it, but we have tools to address it.
That is a huge statement right here. Okay, unpackaging this, okay? She says, look, the odds of us having persistent, remember, persistent means it happens over and over and over again. We expect that cup of coffee to get more expensive not just this year, but next year, next year, next year, next year. That's persistent inflation. Temporary inflation is, damn, that coffee was way more expensive this year than it was last year, but next year it's still the same price. Right? That's persistent versus temporary inflation. Very, very important. And by the way, I get these comments every time. I just have to quick tangent, okay? I hear all the time, Kevin, inflation is the expansion of the money supply. No, in my opinion, and everybody's got their own opinion, okay? But when you're watching my channel, inflation is the reduction in purchase power. Ironically, just because you're printing more money does not mean your purchasing power goes down. I know that's weird, but again, watch the coming Great Depression versus the Roaring 20s, and you'll understand that a little bit more. So, big thing that Janet Yellen just said. Small but manageable risk. Manageable means they're ready to act if the risk becomes extended. Very important. Then she also says, and this is very common because we hear people have these concerns that we're going to see this 10, 12, 13, 14% inflation reading again like we saw in the 70s or 80s. She's saying, I absolutely don't expect that. Those are her, she picked those blunt words. She said the word absolutely. She absolutely does not expect a return to the 70s style inflation. And she gives reasons for that, saying that our inflation expectations are too low, that we think inflation might be 2 or 3%, but nobody's thinking it's time to see inflation go to 10, 11%. And if people don't believe that, then it often doesn't manifest. Because inflation is one of those things where if we expect prices to go up, we go buy more now so that we don't end up buying when prices are up later. This is kind of exactly like when I say the coupon code expires down below, you're probably incentivized to at least check it out because the price of the course goes up over time. As I add more content, the price goes up. But let's go ahead and keep listening to what Janet Yellen has to say.
2017, he testified that long-term budget projections should keep people awake at night. The situation is worse now. Federal debt expected to exceed GDP for the first time since World War II. So are you getting any sleep?
Ha!
I am getting sleep. My views have changed somewhat about fiscal sustainability, in part because what we're...
Okay, that's interesting. Hold on. He kind of just called her out there. He's kind of like, wait a minute. 3 years ago, you're complaining while Trump is in office about how we have too much debt. Now you're in office as Treasury Secretary, and now your views have changed? That was actually a really good question, okay? Props to ABC on that one. That was a good question.
Seen all around the world is a trend toward very low interest rates. Interest rates in the United States are much lower than they were in past decades, and you see that in all developed countries around the world. And it reflects structural trends that are not going to disappear soon. And when I think about the burden of debt, I think about it mainly in terms of the interest payments that the government needs to pay on that debt. And in spite of the fact that the debt has increased substantially, interest payments relative to the size of the economy have remained quite low, no higher than they were back in 2007. But of course, we have to make sure that that the budget is on a sustainable path, and this is something that we can afford. In the longer run, we need to get deficits under control to make sure that our fiscal situation is sustainable.
In other words, now that I'm in office, we got to focus on people not being unemployed because that's going to create more damage to our economic engine. And it's interesting she says this right here. She says, interest rates are tending to trend down. Lower interest rates, aka also lower inflation, are the expectation, and that's because of structural trends that won't disappear soon. What are structural trends? Well, structural trends could be the deflationary aspect of technology, the deflationary aspect of price competitiveness, where you've got people like Elon Musk going, look, we don't need a more expensive car, we need a cheaper car, cheaper car, but also higher quality. And this price competitiveness is a structural trend driven by technology. Let's keep listening.
And that means raising revenue to pay for future programs. What do you think of Senator Warren's call for a wealth tax?
Well, President Biden has put forward a number of proposals. He hasn't proposed a wealth tax, but he has proposed that corporations and wealthy individuals should pay more in order to meet the needs of the economy, the spending we need to do. And over time, I expect that we will be putting forth proposals to get deficits under control.
But no wealth tax?
Well, that's something that we haven't decided yet and can look at. But, President Biden during the campaign proposed a higher tax rate on corporations, on individuals, and on payments, capital gains and dividend payments that are received. And those are alternatives that address, that are similar in their impact to a wealth tax.
Now, these items right here, by the way, are expected to be announced by Joe Biden as potentially part of his next infrastructure package. Whether or not he gets through these higher taxes, that's going to be up for debate. Maybe Republicans come in and say, look, we'll give you the 10 votes you need as long as you get rid of these taxes. We'll see what Mitch McConnell is capable of doing. Mitch McConnell has already expressed his unhappiness with the idea about higher potential taxes. But very interesting. I mean, we have really a Treasury Secretary here, just like the Federal Reserve, and they are redefining how we look at debt. We used to look at debt in this country as how much it is. Now we're looking at it as how much it costs. And by redefining that, now our debt looks cheap. So, there are arguments to be made on both sides here. What kind of narrative were we being fed by the government versus, and the Fed, because apparently they're separate, they are, technically. But anyway, versus what our actual expectations are. And this is why the market is so confused. This is why when bond yields go up, the market goes, well, we're going to trust the bond yields instead of the government and the Fed. So this is really going to be an interesting next few years here. I think most of you know what side I'm on, and you'll get a little bit more insight again if you take a look at that video on the coming Great Depression versus the Roaring 20s. What are we going to have? Let me know your thoughts down below. Take a look at that coupon code that gets you that 38% off expiring today. I don't have my soundboard, but I do have Buy the Dip coffee. See, if I hold it this way, it's a rocket ship to the moon. And if I hold it with my left hand, it's Buy the Dip, yo. Follow me on Twitter at RealMeKevin. Take a look at the last tweet I just retweeted. And folks, see you in the next video.